Welcome back, everyone. Thanks for tuning in to the fourth episode of season two. I'm having a lot of fun doing this podcast, and I've actually gotten a lot of feedback. And I actually had a prospect that I spoke to this morning that was like, "Yeah, I really enjoyed your videos and your podcast. And I basically did a bunch of due diligence and thought that you might be a good fit to work together." So that's pretty cool to see some fruit from the time put in. I know at times it may sound like a low budget podcast, and that's because I do all the editing and all this stuff myself, and that's what allows me to charge clients um, a smaller fee, generally speaking, than a lot of the big firms out there. Is because I run a lean, mean business. And again, I'm just thankful that the viewership has been increasing steadily throughout every single episode. So it's been awesome. All right. So the first topic for today is talking about risk tolerance versus risk capacity. So, in simple form, right, capacity is the ability for the investor to take that risk based on how large their portfolio is, right? Like, would a market downturn really destroy their portfolio? And tolerance means essentially it's synonymous with willingness. So the client's willingness to take that risk. So talking about a few different examples here to help you decide on how to pick the correct portfolio. So the first little case is an investor that might, let's say they have $10 million and they need $50,000 per year to live on. Well, you could argue that that math will work out 99.99999% of the time, in sense that that's not going to destroy their portfolio. And also, they would have a high capacity for risk. They have a high ability to withstand a portfolio downturn, right? If the market went down 60%, they would still have $4 million and they only need 50 grand a year to live on. So that would still be okay. However, they might have a low tolerance or a low willingness for that risk. So that adds another layer of complexity into the situation where if they don't have any willingness for risk, like let's say they're going to sue the advisor for a $1 loss in their portfolio, well, then that means their portfolio will still have to be conservative, even though they could invest their money with a high degree of success in more stock-based investments, equity ETFs, etc., and still be okay. So that's where the human element comes in to decide on how to help this client either take the path of helping them understand, volatility and risk more, or really dive into why. Like, are they just totally fine? They don't want to grow their assets literally at all anymore? Or, where is this disconnect and or efficiency matrix or metrics in their ability to take risk versus their willingness? That's kind of the first case just to think about. The second one, let's say someone has $1 million and they need 80,000 a year out of it. Well, that's 8% per year. So you could argue that their capacity, right, their ability to take risk is really low, because if the market went down, and they were in 100% equities or something, and the market went down 40%, well, now they have 600,000, and 80,000 out of 600,000 is a lot higher than 8%, right? Which is already probably an unsustainable withdrawal rate anyway. So thinking about that versus their willingness, right? Their tolerance for risk. Well, here's where it makes it really hard. And the correct answer is obviously, hey, you either have to lower your expenses or save more money or work longer, or a combination of all of them. However, again, with this case, they have a very, very low ability or capacity for risk, but without taking any risk, that's also guaranteed to fail, right? They can't leave their $1 million in cash and take out 80 grand a year for 30 years. The math simply just doesn't work. So this is where you really have to take a multidimensional approach when you're talking about choosing a correct portfolio. You really have, this is why you hear the classic example of like, oh, well, everyone's different. Or this is why it's impossible to answer the question of what's your average return for clients. That's literally impossible to do because everyone has a different capacity or ability to take risk based on their asset size. And everyone also has a different tolerance or willingness to take risk. And one example, or a third example, could be a young investor who is really, really conservative, has no tolerance for the risk, but yet they have a high capacity because they have such a long time horizon and they can weather multiple storms. And that makes it really tough. Like if you were to read an article, right, just a standard classic thinking article, they'd be like, oh, well, why is this young person in a conservative portfolio? So that's where education comes into play, and this young person's ability to, receive that education, be coachable, or they basically just have to save a huge percentage of their income if they're not able to tolerate risk. And then the fourth example and the last one for this topic is an older person that may have a high willingness or a high tolerance for risk, but a low capacity, right? Again, where they might be able to tolerate, 30-40% drops in their assets, but if they can't afford that, like if they're withdrawing money and then they also take a loss on paper in their portfolio, I mean, that doesn't really make sense. So again, it's important and it's true, right? This is kind of an addition to um, the risk tolerance portion is talking about, okay, why are why is each investor's portfolio different? And part of it is because we have to take a multi-dimensional approach to risk and building out that portfolio. So again, just to recap here, capacity or ability to take on risk versus tolerance or willingness to take on that risk. And that's something that people will develop over time, and it could change over time as well. So it's super important and something that has to be considered when you're picking the correct investment portfolio for you. All right, moving on to the second topic. And this is another logic versus emotion conversation, and something that I borrowed from another podcast I was listening to is talking about software and planning. So I'll make the joke to new prospects where I'm like, if you're interviewing 3 advisors, all of them might be CFPs. All of them are going to say they do damn good planning, and all of them are going to say that they have the best software in the marketplace. It's like, okay, well, how do you decide? And I always, lead that into like personality and how the advisor thinks and things like that. But as far as software goes, one component of software, if you're going to use software just to make all your decisions, that's totally fine, but it doesn't care about you. There's no emotional segment to the software. And I was working on a case this week where the prospect was like, yeah, I want to bucket out money for any major medical expenses. I want to bucket out money for um, my mother, just in case, I have to take care of her financially. Like, I don't expect to do that, but I want to bucket it out. And so the software, that would mean, okay, I just take out assets. And the software is like, oh, now this plan's failing. Like, okay, well, the plan probably isn't failing. We have to use critical thinking to interpret this plan and plan for what the client wants to do. And so again, I feel like the overarching theme of this is that every client's different. Gee, what do you know? But it's like, okay, when you're working with software, it's just a tool. It's just a tool to use to spur a conversation and to give a little bit of peace of mind. But again, that human element and the caring factor play a huge role when we're talking financial planning. And so that's just the main key is that, again, software is really good. It's very good for helping start a conversation to make a decision. But at the end of the day, in my opinion, it just, again, doesn't care about you because it's literally just a computer. And probably just a glorified Excel spreadsheet that's built into a nice clean software in a lot of cases. Now, I don't want to say that it's useless because it does have a lot of practical uses and it's great for people to see, but I'll leave it there. And then the final topic is talking about the real, I guess it's still an intangible piece to planning, and it's talking about adding confidence to your financial life. So something that, I've been thinking about with clients and utilizing and sending over to them is talking about different areas of financial planning and rating on a scale of 1 to 10 how confident they are in those things. Because if you were to take an investor that had a $500,000 house that they owed 200 grand on, and then they had $100,000 in an investment account, well, 500, right? 500,000 minus 200,000 is 300,000 as far as the asset goes, and then another 100,000 in an investment account is a $400,000 net worth. Well, that investor, might feel a certain level of confidence about their balance sheet, but let's take investor B or client B, and maybe that client has a $500,000 house that's all paid for, but $100,000 in credit card debt. So on paper, they're exactly the same. They have that $400,000 net worth, but they might feel totally different about the strength of their balance sheet. And so talking to them about confidence is really key in financial planning. And I've been, a victim of, or not a victim. I've been an advisor that asks clients, or will open the conversation with, "Oh, what are your goals?" And by asking a client that as one of the first questions, "Oh, well, what are your financial goals over the next 3 to 5 years?" They might just freeze up and they might just want to get the question over with as fast as possible because it's you're new talking to them, and they haven't ever told anyone this before, or they just haven't even thought about it. So what's important is to help them and guide them in that direction and say, okay, on a scale of 1 to 10, how confident are you in, where your balance sheet is and your net worth is, and how confident are you that you have the correct amounts and types of insurances, and how confident are you that you have a solid estate plan where your assets are going to go to the correct people in the correct manner? Or how confident are you that your investment portfolio will get you to where you want to go? Because again, and I've said this before, this will add confidence and it adds fulfillment in life. And the ultimate fulfillment, right, is your ability to buy your calendar back because you have the resources to do so and be able to do whatever you want with whomever you want, whenever you want. So, I mean, it's just the overarching theme of financial planning is, really, it's honestly whatever the advisor makes it or pitches to the client, right? If you're going to have a really investment based approach where it's like, oh, we're going to beat the market and we're going to do this and we're going to do that, like, okay, well, have fun working with that client for maybe a year, and hopefully, you beat the market, or else they're just going to leave. And oh, by the way, you can't even control what the market does anyway. So good luck. Or do you have a more long-term focused relationship with that client where you're helping them build confidence over time, knowing that each component of their plan is going to be a focus at one time or another, so that you're adding confidence and they're gaining confidence inside of their plan and their financial lives to gather that higher level of peace of mind. So that is really the ultimate, I guess, takeaway, or the ultimate level of financial literacy, independence, whatever you want to call it, from working with a planner. So just to recap everything that we've talked about, the first topic was talking about risk tolerance versus capacity. So capacity, aka ability to take risk based on your given portfolio size versus your willingness or tolerance level to accept volatility inside of the market. And the second one is just keeping in mind that software is software, right? It doesn't have emotion. It doesn't care about you or your financial decisions. It's just an equation a lot of times that is going to spit out an answer. And then the big part and the big takeaway from that is that you need to have some level of critical thinking and an emotional element that helps you make these decisions. And then finally, talking about adding confidence in different ways. So, my goal in working with clients is for them to have a higher level of confidence each year that we work together based on different, I call them modules, right? Like their estate planning module, their cash flow, their balance sheet, insurance, investments, etc. Add confidence to their financial lives so that they can have a higher level of peace of mind long term. So I will go ahead and wrap it up here. Again, thanks so much for listening. If you like the podcast and like or watch on YouTube and enjoy the videos, please like, follow, subscribe, leave a review. And again, if you have comments or topics or anything like that, feel free to send those along to info@lifepointplanning.com, and I will go ahead and look at those and include them in the show. Thanks so much again, and we will catch everyone next time.